Hello, hi. My name's Jerry Miller, and this is part of our Monday Market Insight series. Yep, you can see the title: Central Banks and Monetary Policy. This is another section, so part two, I guess you could call it. And I just want to start by talking about what happened with the recent European Central Bank monetary policy meeting that concluded the previous Thursday. Um, and most of you will know by now that the ECB has belatedly decided to increase interest rates by 0.25% in the next two policy meetings. That also includes concluding their quantitative easing program as well. The ECB also announced that it could actually increase rates higher than 0.25%, stating that if in the medium term inflation outlook persists or deteriorates, a larger increment will be appropriate at the September meeting. Gosh, I wonder how much worse inflation has to get before the European Central Bank really does move. But anyway, despite the moves to raise rates and end quantitative easing, the euro fell sharply. Let's just have a look at one of the charts. Just have a look at where the euro. So you can see here in the chart of the euro versus the US dollar on Thursday last week, the day of the European Central Bank announcement, the euro it sort of teetered a little bit, then eventually fell down to its lows. And then on Friday, following the very poor or certainly above consensus reading on the US CPI inflation data, the euro fell further. That was more the dollar strengthening, but as much as the euro weakening. And so you can see that the euro seems almost certain to hit its previous sort of pivot levels around the sort of 103.80, 103.50. And parity at some stage further out looks to be on the cards unless the European Central Bank do change their policy. It wasn't just the weakness in the euro that was notable, but more importantly were bond spreads. And these are the spreads that the market tracks between the benchmark German Bund and the heavily indebted southern states such as Italy, Spain, Greece. And it's these widening in spreads that really are a sign of stress building in the Eurozone financial system. Let me just show you a chart from or a table from the FT. This has a table of the German Bund yield, which is currently 1.5%. Just highlight it there. And this is versus a number of other countries, a lot of the Eurozone components in there, but you'll notice that Australia, New Zealand, Austria as well, UK, US, etc. So you can see all the major economies there. And it's interesting to note that Italy, the spread of yields between the German 10-year and the Italian 10-year was 1.9% about 10 days ago. Last Friday, following the poor CPI data in the US, that widened to 2.25%. And now on Monday morning, well, it's currently at 2.37%. It's quite dramatic. Why the sudden move in Eurozone bond spreads? Well, I think when rates were at record lows and the ECB were buying Eurozone sovereign debt, investors were really happy to join the party and invest in Italian, Greek, and Spanish debt, even though these countries were very indebted. The cost of the pandemic, as we know in the UK, our government borrowing has ballooned following 2 years of government spending in support of the economy whilst it was in lockdown. We've also seen big increases in the debt piles of these southern European states as well. Now the music has stopped. And the ECB has announced that they're going to be raising rates. All of a sudden, investors are now focusing on the additional financing costs that these southern states are going to endure. And I think investors clearly are running for the hills at the moment, and they're going to see what happens and whether the ECB might actually provide some sort of help or support. But the warning signs within the Eurozone were bound to happen. And it's sort of a little bit surprising, really, that the European Central Bank weren't more prepared for this outcome. They'll probably say that they have got contingency plans, but it's something that they didn't communicate particularly well last Thursday when they announced their interest rate rises to come. And I think, you know, inflation is clearly going to persist. The reasons for inflation are not going to go away. The war in Ukraine will not go away. There will be no let up in the sanctions because unless Russia cedes the territory back to Ukraine, that won't happen, and that's very unlikely to happen. And I think central banks are having to take some drastic action, as virtually all central banks are way behind the curve trying to tackle this inflation. Okay, I now want to have a look at the Federal Reserve and what's coming out this week. We've got two major central bank releases. In fact, we've got three with the Swiss National Bank, but I'm going to focus just on the US central bank. That's the Federal Reserve first, and then we're going to get onto the Monetary Policy Committee, the rate setting committee for the Bank of England. So, expectations for current and future interest rate rises. It's well, put it this way: following the release of the CPI data last Friday, which was far worse than expected, retail sales jumped. Sorry, retail prices, I should say, jumped far higher than consensus at an annual rate of 8.6%, which was 1% month on month. Either way, both numbers were a lot worse or quite a bit worse than expected. Equities immediately took fright. S&P fell 2.6% on the day. Nasdaq fell 2.9%. For the week, the S&P was down 5.1%, the Nasdaq down 5.6%, and these weekly falls were the worst since January and underline, I think, the challenge that the Federal Reserve is facing as it deliberates interest rate rises this week. So our expectation, I think our expectation or the market's expectation is they've assumed pretty much that the Fed is going to raise rates by 0.5%, and it's on the cards for the next two meetings. In fact, let's have a look at this particular chart from the FedWatch tool, and it actually shows the risk of a 3/4 point increase in the July meeting. So here we are looking at the CME group that tracks the forward Fed funds rates, which basically tells us what the market is expecting on these particular dates of these policy meetings in the future. The week, this week, expectations are for a rise to 1.25 to 1.5. They have a band of Fed funds that they target. The central bank. It's currently at 75 to 100 basis points, or 3/4 to 1%. So that's a 50 basis point, a 0.5% increase. In July, they're expecting a 0.5 point rise, sorry, possibly or more likely a 3/4% rise, which is extraordinary, up to 2 to 2.25%, and then another 0.5 point rise in September. And by the end of the year, we're expecting interest rates to be somewhere around 3.25 to 3.5%. Compare that with what's happening in the Eurozone, you can see why the euro is particularly weak. Okay, now let's have a look at what's happening in the Bank of England and interest rate expectations for our own Monetary Policy Committee this Thursday. Gosh, where to start? The Consumer Price Index, or inflation reading for last month, which was in May, for April, I should say, was 9%, which is the highest since records began. And these are the modern records, of course, and they started in 1989, and it outstrips the 8.4% annual rise posted in March 1992, and it's way, way higher than the 7% that we saw in March, so in the previous month. So what's causing it? Well, it's interesting. Inflation in the UK seems to be higher than other major economies, higher than in the US, just higher than the Eurozone, just. But nevertheless, it is higher, and it's down to a sharp jump in food prices, sharp jump in energy. We know all about energy prices. In fact, you may well know about food prices, but energy is far higher than it was a year ago, but also because of the service industry. So there are a lot of services that the economy is based on. About 80% of its service sector, rather than just the smaller part being 20% manufacturing. Anyway, The Bank of England have got to do a very, very tough job. If they react too slowly, they're going to be accused of being asleep at the wheel and not reacting. If they overreact by increasing interest rates too quickly, and the economy will plunge into a recession if it's not already in a recession, whilst inflation is going to persist because inflation is a global issue, and anything that the Bank of England does will not stop the rise in food prices or energy prices, but they'd still have to act. In this particular scenario, where there's a recession and inflation, is referred to as stagflation. Interestingly enough, economists expect the UK to have the highest inflation rate within the G7, not just this year in 22, but also in 23 and in 24. So we expect a rate rise of 0.25%, with a risk that policymakers may go for a nuclear option, which would be a 0.5% increase and risk a recession. That's if we're not already in one, of course. Thanks very much for listening and watching.